Welcome to our comprehensive analysis on the potential impacts of the deep-rooted Israeli-Iranian tensions on the global financial markets. A region veiled in the intricate fabric of cultural diversity and history, the Middle East has always been a maze of geopolitical complexities. As we venture into this labyrinth, it's crucial to grasp that the persistent discord between the pivotal nations of Israel and Iran aren't mere isolated events, but the peak of a long-standing political and socio-economic contention. Over the decades, the geopolitics of this intricate region have been fraught with instability, triggering ripples in the global economic milieu. At the core of this tumultuous landscape lie the tenacious tensions between Israel and Iran. These hostilities, more often than not, possess the potential to disrupt the equilibrium of the global financial markets, setting off a ripple effect that reverberates globally. Recent events transpiring in these countries, including significant shifts in leadership, formation or dissolution of alliances, and drastic changes in economic policies, have ignited concerns over a potential exacerbation of conflict. As the world observes with bated breath, speculations are rife. The discourse is riddled with questions about the potential impact these escalating tensions could unleash on the global economy and financial markets. Analysts, observers, and experts are scrutinizing these developments, attempting to forecast the unpredictable and comprehend its far-reaching implications. In this video, we endeavor to present an exhaustive overview of the potential impacts these volatile tensions could unleash on a myriad of financial markets. We delve deeper into the potential ramifications on gold, oil, traditional stock markets, and the rapidly evolving sphere of cryptocurrencies. The influence of these geopolitical tensions stretches far beyond the immediate nations involved, seeping into global commerce, finance, and political landscapes. Our exploration will traverse beyond singular perspectives. We will examine a multitude of scenarios, each harboring its own set of plausible outcomes and repercussions. We will dissect the what-ifs, retrace historical trajectories, anticipate potential turning points, and possible fallout. Our investigation will also incorporate expert insights and perspectives, offering you a thorough, in-depth comprehension of the complex issue at hand. While we don't profess the ability to predict the future, we strive to equip you with the tools and insights necessary to navigate these challenging dynamics and understand the potential impacts and implications in their entirety. Thus, without any further delay, let's delve deeper into the potential scenarios and their potential reverberations. Let's delve deeper into a hypothetical situation marked by limited retaliation and de-escalation. In this scenario, the world sees a reduction in global tensions, with geopolitical strife taking a back seat, engendering an environment where a financial safe haven is less sought after. This climate of tranquility permits the financial markets to regain a semblance of normalcy, creating potential opportunities and challenges for different asset classes. In this milieu, the role of gold, a conventional refuge for investors in uncertain times, merits exploration. As the geopolitical landscape becomes more predictable and secure, investors may feel more at ease in putting their money back into riskier assets. This shift in investment strategy could result in a decrease in the demand for gold. Consequently, less demand for gold could trigger a stabilization in its price. It isn't out of the realm of possibility to even see a downward correction in gold prices as the market acclimatizes to the new status quo. Now, casting our gaze to oil, recent global crises may have propelled its prices to unparalleled levels, fueled by fears of potential supply interruptions. The specter of risk can catalyze a price spike as countries scramble to ensure their energy security. However, in our scenario of restrained retaliation and de-escalation, these fears would likely recede. As such, oil prices might backpedal from their recent peaks, allowing the market to rebalance and return a level of relative stability. Simultaneously, let's focus on the stock markets, often regarded as the pulse of global economic well-being. During times of crisis, stock markets can take a beating as investors migrate to safer assets. However, in our proposed climate of de-escalation, the slackening of tensions could pave the way for a revival in stock markets. The increased appetite for risk, buoyed by renewed investor confidence, could potentially trigger a boost in stock market indices. To sum up, the scenario of limited retaliation and de-escalation presents an intriguing perspective to scrutinize the potential ramifications on different financial markets. It serves as a mental model, assisting us in comprehending the dynamic nature of these markets and their reactions to changes in global tensions. Now imagine a tit-for-tat escalation, a visual manifestation of a cyclical exchange of retaliatory strikes that could ignite market volatility. It's like a domino effect, one hit leading to another, creating a whirlwind of uncertainty. Market volatility, a term for the sharp, dramatic swings in market prices, can be a daunting prospect for investors, traders, and anyone with a stake in the financial realm. In such a situation of tit-for-tat escalation, these unpredictable price shifts can be even more critical and concerning. They can shake the very foundations of financial stability. The impacts of such an escalation are multifaceted, but let's zoom in on a few key arenas. First, let's delve deeper into the situation with gold prices. In times of uncertainty, investors often seek refuge in what's known as safe haven assets. These are investments that retain or increase in value during times of market turbulence. Gold is one such asset, long revered as a solid, trustworthy source of investment, a beacon amidst the fluctuating undercurrents of the market. In our hypothetical scenario of tit-for-tat escalation, we might see gold prices surge as investors scurry to protect their investments. The demand for gold could skyrocket, possibly leading to an unprecedented hike in its prices. Investors, wary of the turbulent market, might turn to gold as a safe storage for their investments, possibly leading to a significant increase in its value. Next, let's turn our attention to oil prices. Oil, often described as the lifeblood of many nations' economies, could see a spike due to increased concerns over supply disruption. In a tit-for-tat escalation, disruptions could trigger seismic shifts in oil-rich regions, leading to potential supply crunches. The ripple effect would mean that the uncertainty surrounding oil supplies can inflate its prices, impacting various sectors from transport to manufacturing and setting off economic tremors that could be felt globally. Switching gears, we come to the stock markets, a melting pot of businesses and industries. Stock markets might experience a wave of sell-offs as investors shy away from risk and seek to protect their assets. It's not uncommon for stocks to take a hit during times of uncertainty. With escalating tensions, investors might choose to offload their stock holdings. The sell-offs could be widespread and indiscriminate, affecting various sectors from tech to retail, leaving a noticeable dent in the market's overall health, potentially triggering a significant market downturn. Lastly, in the realm of cryptocurrencies, they too are not immune to the effects of a tit-for-tat escalation. Bitcoin and other digital assets might face a substantial amount of selling pressure. The volatile nature of cryptocurrencies makes them a prime target for investors looking to minimize their exposure to risk during turbulent times. Investors might cast a wary eye on these digital assets, leading to a considerable decrease in their market value. This scenario illustrates a cycle of retaliatory strikes with the potential to fuel substantial market volatility. It highlights the complex interplay of various factors in the financial markets and the potential fallout from a tit-for-tat escalation. An even more profound scenario to consider is the direct U.S. involvement through a spectrum of potential intercessions. This could range from military strikes to augmented backing for Israel. This step, though it might appear drastic, cannot be entirely ruled out. The history of the U.S. is characterized by periodic interventions in conflicts that challenge their national security. An escalating situation in the Middle East fits this framework, which could incite the U.S. to take action. The nature of this intervention could be multifaceted, encompassing on-the-ground military aid to strategic airstrikes aimed at dismantling key infrastructure. Such an approach from the U.S. could substantially escalate the conflict leading to a ripple effect impacting various sectors. One of the immediate repercussions could be felt in the economic landscape, affecting markets worldwide. This escalation could spark a period of severe economic turbulence and instability, with heightened geopolitical risk factors provoking apprehension among international investors and corporations. The direct impact of this escalation on the gold market could be significant. Gold, being a traditional safe haven asset, could witness a surge in prices, potentially reaching new record highs. Investors, in their attempt to shield their wealth from the ensuing economic upheaval, might resort to gold. This heightened demand for gold could an upward spiral in its value, setting off a cyclical pattern of increased demand and price. The oil market, a critical player in global economics, could also bear the brunt of this conflict. Any disruption in oil supply due to escalating tensions in the Middle East can lead to abrupt hikes in oil prices. The apprehension surrounding potential conflict and the ensuing uncertainty could drive prices to soar, presenting challenges for countries heavily reliant on oil imports. The shockwaves of this escalating conflict could also reach the stock markets. Investors, in response to escalating tensions and subsequent economic instability, may decide to offload their holdings. This could trigger significant sell-offs in stock markets around the world, causing prices to nosedive, setting the stage for a bear market. In the realm of digital assets, despite their decentralized nature, cryptocurrencies could experience the fallout of this economic turbulence. Cryptocurrencies, although resilient, are not immune to market fluctuations and investor sentiment. As fears escalate and investors strive to mitigate their risk exposure, cryptocurrencies could undergo a severe downturn as investors retreat from risk. Indeed, diplomatic efforts and negotiations have the potential to play a pivotal role in diffusing geopolitical tensions and thereby stabilizing the markets. This is a situation that investors worldwide are keeping their eyes on, waiting with bated breath. As diplomatic dialogues commence and negotiations move towards feasible resolutions, the possibility of easing tensions and stabilizing markets becomes increasingly palpable. Such diplomatic endeavors often lead to an enhanced mutual understanding and commitment between conflicting entities. These engagements can foster trust, de-escalate tensions, and pave the way for cessation of hostilities. Consequently, this can result in a more predictable and secure environment for businesses and economies to operate in. An environment of peace and stability could lead to a surge in investor confidence. As tensions ease, investors' fear of geopolitical risks decrease, encouraging them to invest more freely. This surge in confidence can lead to increased market liquidity, lowering the cost of capital for businesses and fostering economic growth. Moreover, stabilized geopolitical circumstances can help in creating a more predictable business environment. Increased predictability often reduces market volatility, which in turn can lead to more stable financial markets. This stability can be beneficial for both businesses and investors, as it reduces the risk associated with investments and can lead to higher returns. Furthermore, successful diplomatic initiatives could quell the fears of supply disruptions, a major factor contributing to volatility in oil prices. If tensions ease, the uncertainty surrounding oil supplies could be quelled, potentially leading to more stable oil prices. This could be a significant relief for industries and consumers that heavily rely on oil. In conclusion, we underscore the potential of diplomatic efforts and negotiations in easing tensions and stabilizing markets. They can lead to a surge in investor confidence, create a more predictable business environment, and quell fears of supply disruptions, all of which can contribute to a more stabilized global economic landscape. To begin, let's delve deeper into the potential far-reaching effects of the Israeli-Iranian tensions on various financial markets across the globe. The exact direction and intensity of these impacts hinge predominantly on the perceived risks inherent in each emerging scenario, as well as the potential implications for global economies. To appreciate the intricacies of this situation, it's crucial to grasp how risk perception influences the financial markets. In times of geopolitical tension, perceived risks can significantly sway investor behavior. The fear of instability can lead investors to pull out of riskier assets and shift towards safe investments, triggering considerable market fluctuations. It's this interplay of perceived risk and market response that ultimately dictates the direction of the global economy. Now let's consider possible scenarios. A further escalation of these tensions could have profound effects. For instance, the demand for safe haven assets could skyrocket. Gold, a traditionally safe investment during geopolitical unrest, may experience a surge in demand, primarily because it's a finite resource that has historically maintained its value in times of crisis. Similarly, bonds, especially those issued by stable governments, may see a spike in demand due to their perceived reliability during times of uncertainty. Further, the US dollar, frequently considered a global reserve currency, may also see a surge in demand. This is due to its perceived stability and strength in the global economic arena, making it a favored safe harbor for investors during turbulent times. Moreover, an escalation could lead to a significant increase in oil prices, owing to possible disruptions in the supply chain. This surge could potentially trigger sell-offs in volatile markets like stocks and cryptocurrencies, leading to a shift away from riskier assets. On the other hand, a successful de-escalation of tensions could provide a sense of stability, potentially reversing the aforementioned effects and stabilizing or even improving the state of these markets. Finally, the importance of monitoring the geopolitical landscape cannot be overstated. Dynamism of geopolitical circumstances and their corresponding impacts on financial markets necessitates constant vigilance. Staying informed allows for preparedness and the ability to make knowledgeable investment decisions. It's essential to understand the interconnected nature of geopolitics and financial markets. A change in one often signals a change in the other.